I am joined by Kerry Bubb, President and founder of KWB Wealth. And I just want to start off by prefacing that Kerry and I are not tax advisors, we're not CPAs, nor are we lawyers or attorneys. Everything that we are discussing here today is going to be broad in nature. So please take that into consideration. You're going to get a lot of information today I think will be helpful for you, but if you want to talk about your specific situation, it would require meeting with a team of advisors to be able to really help guide you in the right direction. And with that, we'll kick it off, and Kerry, I'll pass it to you on what we're going to talk about today.
Yeah, hey, thank you, Rachel. As Rachel said, my name is Kerry Bubb. I am the president and founder of KWB Wealth. Today I want to reiterate what she said. We're going to make a shallow dive, not a deep dive into these topics because they're complex. And I think a shallow dive to make sure people are aware of the various entities can be great as you plan your future. So when we look at these entities, really what we're looking at is how do we help reduce taxes? We'll call that the sword. And how do we shield ourselves from liabilities? And we'll call that as far as the shield, as you think of yourself as a warrior. Because what happens is we're in a very litigious society. All you have to do is drive down the interstate and you'll see signs for, have you been injured? Call Larry Parker, call Jacob. And, what we want to try to go through today is a little information about how high net worth people structure their businesses, their entities, and their life to help mitigate some of those challenges. So today we're going to talk about LLCs. We're going to talk about S Corps, a little bit about C Corps, about sole proprietorships, and then the sword, the tax strategies, asset and liability considerations, and then we'll wrap it up with a case study just so you can see how things can get really complicated if you want. So Rachel.
Yes, it can get very complicated. And I think when we are thinking about doing this, we really did want to do more of a deep dive. And as we got into it, we realized there are so many intricacies in making decisions for your business because really what you're doing when you're creating an entity structure is you're defining how your business is formed, how it's going to be operated, taxed. It's going to determine your liability. It's going to determine your control. It's also going to determine your succession planning and your exit planning strategy. So there's so many factors that need to come into play, and we can't just cover it in 30 minutes. But at least you'll have a nice idea of where you need to go to next after this. And one thing I want to preface is when you do go ahead and set up your entity, your business evolves over time. So the decision that you made today at the start of your company might need to be reevaluated in 5 to 10 years, depending on the company's growth. Maybe there's been some changes in your profit margins, your head count, how much you're spending to be able to keep up with infrastructure or the changes in like AI technology, for example. Tax law changes will also impact whether you need to make a change in your entity structure. Maybe you bring in new partners into the company. So then you need to think about maybe we're no longer a single member LLC, but now we're a multi-member. So we need to reevaluate what entity we are today. Also, you might have a family member that eventually comes into the business. That's another reason that you might want to look at your entity structure and decide, do I need to make a change? Because if with family members, there's opportunity to pass on the business or even have a better outlined succession strategy or exit planning strategy. So we don't say create the entity today and never reevaluate it. It's not something you need to reevaluate annually, but you might want to look at it every couple of years. And when you do make that change, you need to be really confident in that change. Because, for example, if you went from an S Corp to a C Corp, you are revoking your S Corp status for 5 years. So you can't go back within 5 years from that C Corp to the S Corp if it was more favorable for you to be in that S Corp. So making these decisions, you want to bring in your team to make sure that you do the right thing because it can lead to some complications. So now I'm going to pass it to Kerry. Why don't you tell us about the different entity types out there that we're going to discuss?
Perfect. Thank you, Rachel. Yeah, the most common is probably the single member LLC or just a limited liability company. And a limited liability company is the beginning of how you position yourself to separate business assets from personal assets. So you could set up an LLC, and let's say you own a rental property, you could separate that business asset, put it into the LLC, and then what happens is it is a pass-through entity for taxes. So, whatever you earn on your rental property after your mortgage and expenses then flows through into your personal return. No separate return is required. The reason you would set up the LLC is because if somebody trips on your property, maybe your tenant has a visitor, whatever, and all of a sudden they end up suing you, then the idea of the LLC is that the judgment that they may get can only be satisfied with that single property, not your other personal property, like your own home, like your bank accounts and other things of that nature. Of course, in any kind of lawsuit, though, having experienced them and being involved with other clients, is when you are sued, they're going to name everything. They're going to name the LLC, they'll name you individually and whatnot. But it is that first shield of asset protection. In the LLC, you get to decide how you want to treat the income. Do I want to be a sole proprietorship? Do I want to be an S corp status? Do I want to be a C corp status? And we'll get that into the nitty gritty in a little bit. The next type of structure is an S corp. So if you have an operating business like KWB Wealth today is an S corp. We have the ability to pay our salaries and wages, and we do payroll. And then any earnings above and beyond can be distributed to share owners in the form of a distribution. Those distributions then are taxed at ordinary tax rates. The whole reason someone does an S corp is because you're trying to shield maybe some of the earnings that you have and not pay FICA taxes on all the wages. So you pay yourself a reasonable salary. Let's say you make 150,000 as a psychologist, you pay yourself a reasonable salary, 100, you pay FICA taxes, and then the 50,000 is not subject to the FICA tax. So the big idea there is it's the FICA savings for a lot of, single person, multiple person entrepreneurs. Then it's also, you're limited to the number of owners, and we'll get into that in the next couple of slides. A C Corp. So let's say you buy stock in a company that's publicly traded, more than likely, I'm sure they're a C Corp. They have more than 100 owners. And what they're trying to do is have owners that maybe are all over the world. Because S Corps, you have to be US citizens, and C Corps, you can be anywhere. And what happens in the C Corp is earnings are taxed at the corporate rate. Today in America, they are taxed at a flat 21%. That's something that was reduced back in the 2017 Tax Cut and Jobs Act. So the problem with the C Corp, though, is if you do have earnings and you pay your 21% tax, and now you want to make a distribution to your share owners, those share owners have to pay taxes on those distributions. So it's some sort of double taxation. Now, there are treatments to get dividends out from corporations on the stock exchange that are qualifying, which makes it a little bit more appetizing. Then you have limited partnerships and family limited partnerships. Limited partnerships is just an agreement between you and another person. And so here what's happening is it's not really ideal for asset protection. It's more just simplified. How do we come up with a plan to manage these apartments or whatever we want to do? However, back in the day, they used to use limited partnerships and family limited partnerships to help mitigate liabilities, because you could make it very complicated for somebody that had a judgment against you and your partnership to do unfavorable taxation treatment to them while they're waiting there for, the revenue to come in from some kind of a lawsuit. So family partnerships, limited partnerships, not really a good asset protection tool. It's more about estate planning, transferring ownership with your family, and family wealth. And then you have a trust. At KWB, we recommend a lot of our clients set up a trust. A trust is where you're taking your desires and putting them in writing and saying, when I die, my spouse is in charge. And if she's not here, then my children. And then everything is divided equally among those children. So the trust doesn't really do anything for asset protection. It does more for reducing potentially estate taxes. It also is a much more private way to distribute assets that you might own to your kids. Because when they go through probate, it's a very public process. It's public knowledge. In a trust, your wife, your kids step in, they transfer ownership of your S Corp over to your kids, and it's easy. So the trust is like the bow that we put on all these various entities to make sure they transition from you or your spouse to ultimately your family or your heirs.
All right. So now you know a little bit about all the different entities that are available to you. And let's talk a little bit about the tax strategies and some of the optimizations that you can do, specifically with LLCs and the S Corp status. Before we jump into that, I want to show this slide here just to break down how your income is actually being taxed and the different types that you have. Most of your income that you can see here that you receive in any form, ordinary income, non-qualified dividends, short-term capital gains, interest income, rental income, K-1 business distributions, that's all going to be taxed at the federal income tax bracket rates between 10 and 37%. So 37% is that highest earner, 10 would be that lowest earner, or 0 if you're not making any money. But this is where most of the income that we receive, you're going to fall within those tax brackets. Where there's more favorable opportunity is in the long-term capital gains or those qualified dividends. You can see here that the tax rate ranges from 0% to 20%, 20% being on the high end, and that would be as if you were at the highest tax, a higher earner, you're going to pay 20% on those taxable, on those long-term capital gains or qualified dividends. Kerry had mentioned that in a C Corp, you get that double taxation. So it's that 21% at the corporate level. And then when dividends are passed down to shareholders, it's more favorable, or it can be. And that's if it's treated as qualified dividends. So you can see here that that would be the opportunity. But if you're doing a C Corp for that more favorable tax return or tax rate, you do give up some other things. So we don't like to make decisions for our what entity structure that we're going to do just based on taxable income strategies or tax rates. There's more involved that we want to get into it. But this, you can at least see that really it's hard to avoid the ordinary income tax rate between 10 and 37%. Now let's talk about LLCs. LLCs default taxation is going to be a sole member or single member LLC. So this is where you're taxed as a sole proprietorship. And this means that all of your income and your expenses are going to be reported on your Schedule C of your personal tax return, or the owner's personal tax return. There is no separate business tax return that's required to be filed. So it makes it really efficient. It's not as complex as some of the other entity structures. This is a great way to do it if you're a small business owner or a solo entrepreneur, and you just want to maintain control. You have maybe 1 or 2 employees, but you own the entire business. And this just means too that you are able to pass down like the income that you receive, and then you also deduct all of your expenses from whatever you put into from your income from what you put into the business that year. So you can also manipulate a little bit of your net income at the end of the year, but all within reasonable guidelines to make sure that you don't become a target to the IRS. All right, the other way that an LLC could be taxed could be a partnership. And this is if you have multiple members of your LLC. So Kerry had mentioned that if you're going to do an LLC and you want to have partners, what's awesome about the LLC option for a partnership is that you can have it doesn't just have to be US residents or US citizens. You could bring in foreign entities, foreign individuals. You have more flexibility in who can be partners here. And when you do have multiple partners, what's going to happen is you have to file Form 1065, which is a partnership tax return. Everything still passes down to the individual shareholders or the partners onto their tax return, but you're going to get something called a K-1 that reports your share of the profits and losses. The cool thing about an LLC too is that just because maybe Kerry and I own it 50-50, it doesn't mean that we have to distribute the profits and losses equally. So we can have some discrimination, or at least allocate it disproportionately to our ownership percentages. Similar to the sole proprietorship LLC format, you are going to have to pay self-employment taxes, but this is great for those small business owners that have multiple owners and want flexible profit distributions. Okay, Kerry, why don't you tell us about the S Corp status?
Okay, S Corp status. So S Corp status is something you elect, and you can set up a corporation and be the S Corp Or again, as Rachel said, you can remain as an LLC and just select S Corp status. At KWB, we are an S Corp. So what does that mean? That means we're a domestic corporation. That means we have to have less than 100 share owners. All the share owners have to be US citizens or resident individuals. A partnership, a limited liability company, or other corporations cannot own shares per se of our our S Corp at KWB Wealth. And there's only one class of stock. Everybody gets the same class of stock, and everybody gets a K1. A K1 takes the income that the company makes and it passes through to the share owners based on their respective amounts of ownership. So if you remember, Rachel said in an LLC, we could discriminate. In an S Corp, we can't. In other words, if Rachel is a 5% owner, then what happens is 5% of the net profits go to her and are taxed as ordinary income. So why do people go and set these up? Is if you're profitable enough to pay the owners reasonable salaries and then have additional distributions to make above and beyond, that would be a good reason to set up an S Corp. So let's say you're a psychologist and you're able to make $150,000 a year in income based on your services, and you could reasonably pay somebody $100,000 to do the same thing. So you could then do an S Corp. You could pay yourself $100,000. That portion would be subject to the FICA, both employee and employer, about 15%. And then that other portion remaining would still be subject to ordinary income. But then the extra 50,000 that you make, you could pass that through as a distribution. So what you would basically be doing is saving about 15.2% in payroll taxes on that extra $50,000. So that's like $7,500. It's not chump change. So if you want to reduce your self-employment taxes, that's probably the number one reason to consider the S Corp, but you have to be a US less than 100 shareholders. You have to have annual meetings. You have to document the meetings. You have to have a board. You have to have structure. And so it elevates the complexity of maintaining that entity for those tax benefits. Rachel.
Okay, thanks. So we go through all this trouble to ultimately have some protection, right? We want to make sure that our assets, our personal assets, most importantly, are protected from the business assets, because that's where we probably have the most risk. Or some people just like to isolate risk within all of their different elements of their balance sheet. And I'll get into that a little bit. What I want to highlight first is that if you don't do anything, if you don't elect any sort of entity, but you go and open up a business and you're reporting the income, you're going to be taxed as a sole proprietor, or you're going to be set up as a sole proprietor, which means that you have no protection. So your personal assets are going to be at risk. If you have employees, then their actions are going to be at risk to you. It doesn't mean that you have to set up an LLC or some sort of corporation. An artist, for example, would be fine, I would say, depending on their other elements of their situation. If they've got a bunch of other personal assets, that might be a little bit different. But an artist might be fine with just registering as a sole proprietor and reporting the income that way, because they don't have a lot of risk to them. Ultimately, though, if you are a business owner with more assets, you're going to want to use these entities to help isolate the risk, because it's going to protect your personal assets from your business liabilities. And one thing that comes up for us is, well, which state should I do an LLC or an S Corp in? So there's some states that are more favorable in terms of privacy. So people like the idea of setting it up in Wyoming, Delaware, Nevada, for example. Those are some of the common states that are the most privacy favorable. However, that only really works for business owners that have businesses that aren't generating income in the state that it's domiciled in. So if you've got a business that's brick and mortar or a single state operation, or you're providing services in one physical location, it's going to be pretty hard to set up an LLC outside of that state. You're going to have to set it up in California. However, if you've got an online business, or maybe you're a consultant and you have more passive income from real estate investments, then you might have an opportunity to set up the LLC outside of your domicile state. Another thing that people will do is, if they've got personal assets, and I think Kerry mentioned this a little bit earlier, if you've got a plane or a second home or a boat, and you've got people that work on those facilities or those personal assets that you have, but you don't generate income from them, you might want to put the individual pieces or those assets into an LLC because you want to prevent risk of something happening on those properties that they can come after you and your all of the rest of your personal assets or your business assets. So that's another reason that people might set up multiple LLCs and then outside of the state that they're actually living in. Ultimately, one thing that we do recommend is that if you're going to set this up, have the LLC, but then also add something called umbrella coverage. Umbrella coverage is going to be personal liability insurance, business liability coverage, and it's going to cover the liability beyond your standard policies. So you want to make sure you have your policies already. So make sure you have, the malpractice risk insurance, make sure you have home insurance, property insurance, all of that. But then on top of that, layer it with umbrella coverage, we can help protect against larger lawsuits or larger claims. And another way to protect yourself ultimately as well is to make sure you're doing all the right things to make you less of a target to the IRS's back. So maintain proper records, have separate finances for all the LLCs that you set up, adhere to those legal requirements. That's going to be really important to make sure that you don't end up being subjected to an audit, for example. So just to sum it up, who needs to consider all of these things? A physician with malpractice risk, great candidate. Real estate investor with tenant claims. A business owner with high revenue and high employee liability, also great candidates. And these are the tools that you're going to want to think about. Maybe use multiple LLCs to isolate your assets. Kerry's going to give us an example of what that could look like. Then you're going to want to integrate trusts with unique names to help hold the ownership of all these LLCs. That can make it harder for people to identify where your assets are. Make sure you tie in some umbrella insurance. It's cheap, it's effective. And then lastly, maintain that corporate hygiene.
All right. Thank you, Rachel. So let's take a look at a case study. Being in this business for over 30 some odd years, I've seen a lot of different things. I've even had a client that had their own house and then just their second house, that it wasn't a rental or anything, but they still put it in an LLC separately so that if anything happened on that property, they couldn't again go against maybe the other personal properties of that husband and wife. So let's take a look at the case study. What we have here is a husband who owns a real estate construction company with 15 employees. And they make a good living. They have enough income to pay for their salaries, and they make distributions above and beyond. Then there's the spouse, and she's a self-employed psychologist. She has no employees, makes $150,000 a year, and rents just a small suite to provide that individual service to customers or clients. And then additionally, they own their own residence here in California. They have another vacation rental property in Idaho that they Airbnb. And then they have 3 other rental properties in the state of California. So what might the structure be for them? Well, as you look at deep dive, ABC Construction would be a great opportunity for an S Corp. So if you'll bring that slide up. The S Corp would then have income coming to the owners and the employees, file taxable returns, W-2, do all the payroll taxes, and then any distributions above would go to then the owners, at ordinary tax rates. So the ABC Corp might have the yard, the trucks, the equipment inside the corporation. Something bad happens, ABC gets sued, then they're limited to their recourse with those assets within the S Corp. The spouse might actually set up just an LLC, and she could be taxed as a sole proprietor and just pay FICA taxes and everything and runs through the Schedule C, or she could elect S Corp status. And the reason she could elect S Corp status is she could say, well, look, I could pay someone $100,000 to do what I do. And so that's a reasonable salary. And then the other $50,000 would come out as just distribution and not be subject to the extra FICA taxes. Currently today, it's about $171,000 is what you have to pay FICA taxes on. So in this case, that might save $7,500 in taxes for that spouse that is the psychologist. Then the vacation rentals in Idaho. So if you're an Airbnb and you're renting your properties out, you might set up an Idaho LLC. The idea here is you're collecting rent, something happens with a vacationer, they trip, they fall, they sue you. Now, the only recourse they have is really that LLC that owns that vacation rental in Idaho. Of course, as I said earlier, if somebody trips and falls, chances are they're going to name everybody they can in the lawsuit, anybody that they can find, and try to get as much as they can. Just that's how things work in this litigious world. Now let's take one more final look at the 3 rental properties in California. So this is where it kind of gets into my thing. It's like, well, how much do you want to do to try to mitigate this risk and also taxes? So if you have 3 rental properties in California, and let's say you just had 3 rental houses, you could elect to put all 3 into one LLC. The negative there is that if somebody trips on one of the properties and falls and gets a judgment, then they can go after all 3 properties in that LLC to satisfy that judgment. So what you could do is you could say, well, I'll stop that. I'll do 3 LLCs. Well, in California, remember the minimum fee is about $810 a year for the LLC. And then you've got, basically 3 types of tax returns, all with K-1s flowing into your personal return. So chances are your tax preparer will charge you more for those additional returns and K-1s. So that goes back to, well, if I have a good liability policy on my rentals, do I need to go to that extreme? Now, if those 3 properties were, a 30 apartment building, unit apartment building, and 2 large tilt-ups or with great assets, then it probably makes sense to go to 3 separate LLCs to mitigate that liability. Again, the whole idea of the LLCs and the S Corps is to separate those business properties so that if something happens, it can't go after you personally. And you want to try to make it as difficult as it can be for people with judgments or whatnot to go and get all your assets and also your personal assets. And that's why the structure is so important to try to mitigate this. And in this case, we might own the ABC Construction S Corp. We might own the LLC, the vacation rentals. All of those things might ultimately be owned in the trust to avoid probate and to mitigate estate taxes, but they would be multiple entities, all different, owned by one that ultimately passes, on to your kids and your spouse.
Yes, there's a lot of things that can make your decision complicated, and I think what's exciting is if this feels relatable to you, it means that you've done a really great job setting up your balance sheet, your net worth, and you've really created a thriving business and income for your family. And now it's really looking at, are you doing all the right things to protect yourself? Are you also looking at your long-term goals and your financial plan and making sure that the decisions that you made today to set up that business is still integrated with your retirement plan and that maybe that future exit strategy. So if you're serious about learning more about these concepts or talking about your situation, you want to talk about a retirement plan that aligns with your business plan, or making sure that you even have a retirement plan with your business plan. I think one thing we notice with business owners is the business is the largest item on your balance sheet. So being able to make sure that you have an exit strategy is really important. So come talk to us if you got $500,000 in revenue from businesses, whether it's from real estate investments, operational businesses, services. These are all the things that we discussed today. We can talk about for you and what are the things that you need to be considering to make sure that you're doing all the right stuff. So thank you so much for your time. Our information's on this slide, and we hope to hear from you.
Have a great day.